George Tsilis is joining us to talk some transports. GT, it's not just Boeing, all right? We're going to talk about Boeing, but the whole group has not been making highs. It's close, and there's not like a major, sell-off happening by any means, but they're lagging. What does that mean to you?
Yeah, if you look at the overall transports, they have been lagging the overall broad indice, the S&P 500. And the other thing that's lagging too is the small caps. So those transports and small caps have been underperforming, but not necessarily all of the transports are still in the same boat with the entire group. The railroads, OJ, have done extremely well. A couple of railroads in particular, Union Pacific, CSX Railroad. Both of those companies are up year to date about 22% respectively. So it seems to be very focused in on not necessarily just airlines, but primarily, if you look at the breakdown of the transport index, FedEx is a huge component of that. UPS, another huge component of it. So I think the transports are not necessarily giving us some information of weakness in the domestic economy, because if that was the case, we'd see railroads in the soup with the rest of the transports. But I think what we've seen with the transports, ideally speaking, is what's going on internationally, particularly FedEx, which is highly sensitive to the international marketplace, being an international shipper. And this company's down about 33% on a year-to-date basis. So I think this is one of the reasons why, OJ. But overall, I mean, you have to look at the rails as less exposed from the standpoint of international trade. United States is, again, less export sensitive than places like China. But the strong dollar is also creating a situation where there's huge consumer demand, low inflation, but the railroads themselves have been primarily insulated from a lot of these aspects of international trade and sensitivity associated with it.
George, what do you say to those who will go, because let's put a perspective here. The Dow transport theory and the Dow theory element of the significance of things like planes, trains, and automobiles underperforming is one that is purportedly a leading indicator. So the reason why we're discussing this is because some people put a lot of credence in this, and there's some decent logic behind it. But George, one could easily just go, well, FedEx, it's down. It just ended its express service with Amazon. Everything's heating up for shipping. It's got nothing to do with the economy. It's got to do with technological innovation. What do you say to that?
Well, I think there's some element to that. I think that the competitive aspect of companies like Amazon competing with FedEx and UPS are creating problems for them. And it might also be a relative weighting issue. If we look at the transport index, if FedEx is the largest component, maybe it shouldn't be weighted as much relative to other companies. And that might be another issue behind some of the flawed aspects of the transports, again, leading the marketplace. Because if you look at the broad market, we're hitting some, or close to, some of those all-time highs. The transports have certainly lagged, but I'm looking at all transports. I'm trying to be sort of agnostic in the sense that, yeah, we see some railroads performing very well. We see FedEx and UPS underperforming. But even if you dig deeper into some of the airlines, they are actually balance sheet sensitive. Delta Airlines, not very sensitive to the 737 MAX, has a very nice and healthy balance sheet. American Airlines, underperforming, and that company's down because it's got some balance sheet issues, debt issues, and some idiosyncratic company-specific issues. So you have to kind of look at across the board, not necessarily different industries within the transport, but even companies themselves which have specific gains relative to some of their competitive losers. Yeah.
George, the other thing I'll say is when you look at the rails specifically, you've got a rally that really has been one of the more consistent ones in this market over the last 2 years. The growth stuff has gone up and down. The S&P 500 has gone up and down. A lot of stuff has netted out positive, but few have been as consistent as companies like CSX. So there are some very bright spots in here.
There are. I mean, CSX and even Union Pacific also, if you keep in mind, these are primarily North American and South and of course Mexican transport-based companies. So they're not necessarily exposed to some of the things that are going on in Asia. From that standpoint, the strong dollar has also, again, created higher fuel prices, and also these companies transport fuel. So they are users of fuel, but they're also transporting fuel. So they get a benefit, if you will, if fuel prices rise, whereas, again, airlines traditionally, suffer from an earnings per share standpoint when fuel prices do rise. So I think there's an element there. They're a little bit more or less sensitive to what's going on internationally. And if you look at the market share, Kansas City Southern, CSX, Union Pacific, they're very, very concentrated railroads. And that itself, again, is also creating a situation where you have, you have very low competition. Each one of these companies sort of has a regional lock on their respective markets, and they're not necessarily competing as aggressively as they were in the past. So there seems to be some industry concentration that is also keeping these rails to the upside as well.
All right, George, nice. A good reminder here that we've got dispersion in the market, winners, losers, and right now on the transports adding up to a group that is lagging. So we'll watch it because it's been lower highs for transports. We'll see what comes next.